The majority of people go to work every single day to make money, and then they spend this money on rent or their mortgage, on food, and a little vacation here or there, and then they wonder where all their money went. Hey, where'd you go? But what if I told you that there was a way that you can clone yourself? You mean like this? Cool. No, I mean clone the way you earn money. That way you don't have to physically go to work each and every day to get paid. All right, Jaspreet clone, I'm going to sleep. Go make some YouTube videos. Whew. Well, it is possible, and you don't even need a clone who's gonna go to work for you while you're sleeping. Investing is a way for you to multiply your income slowly, but instead of you going to work, you send your money to work, and your money is gonna work 24 hours a day, 7 days a week to attract you more money. Now, unlike what everybody on the internet says, it is not easy, and it does not happen overnight. It is a slow process for you to grow your money by sending your money out and slowly attracting you more money. This way you can build more wealth. To understand how this works, let's pretend that everything you do is an investment. You need a car, vroom vroom. You can spend $60,000 on a sweet Beamer, or you can spend $8,000 on a nice and used working Toyota. Both cars will safely take you from point A to point B, but when you drive that Beamer, people are gonna go, whoa. But when you're driving the Toyota, they're gonna go, oh. If you buy the Beamer, you are investing that extra $52,000 to hear people say, whoa. With the Toyota, you get to save that $52,000 in your pocket. When it comes time to sell your car, you were gonna sell your car for less than what you bought it for, whether you get the Beamer or the Toyota. But with the Beamer, you're gonna be out tens of thousands of dollars more, but at least you heard people say, whoa. It's the same for your clothes. You can buy $1,000 buying a scarf at Gucci, or you can spend $100 buying a whole wardrobe at Walmart. When everybody sees you in the Gucci, they're gonna go, hey. When they see you in the Walmart, they'll go, hey. In this case, when you buy the Gucci, you are investing $900 more to hear people go, hey! And by the end of the time of your clothes, both of your clothes, whether it's from Gucci or Walmart, they're gonna be worthless. These are your obvious bad investments. I actually call these your consumer expenses, because as soon as you spend your money on these things, whether it's your car, your clothes, things like that, as soon as you spend your money on these things, your money is gone. These consumer expenses are the things that can help you look rich, but they keep you broke. But now, what about the investments that are not consumer expenses and that are not so obvious? Now, you take that $10,000 that you worked so hard for, and now you don't go and buy a car, you don't go and buy clothes, you save it. Now, you think you're doing the right thing, because if you spent that $10,000 on a brand new car, that $10,000 will be worth half of that amount in just a few years. And if you spent that $10,000 on clothes, it would be worthless. Now, your investment isn't doing half bad, because you can open up your bank account in a year or 2 years and still see that you have $10,000 in cash sitting there. If you bought clothes or a car, that $10,000 would be worth nothing. But if you're watching this video, you don't want to make half bad investments. Your goal is to build more wealth so you can live a financially better life. You need to have some money in your savings account, okay? That money is there to protect you from going into debt or to protect you from an emergency. You need that. But your savings are not there to make you rich. Saving your money is financially better than buying a bunch of nice cars and clothes, but it is not going to make you rich. Rich people did not become rich by saving their money. The only way that you can add to your wealth without physically working harder at your job or getting a promotion or working longer hours is by taking your money and now sending this money to work. Not by buying a car or clothes or saving your money, but putting it to work in a way where your money is going to attract you more money. The nice thing about this is your money doesn't get tired. It doesn't need to sleep. It doesn't need days off. It doesn't want long weekends off. And it doesn't need to go to the bathroom, okay? Your money can do a much better job at earning money than you can. And your money's efforts are scalable while your efforts aren't. You can only work 10, 12, 15 hours a day, but after that, you're capped. You cannot work 24 hours a day every single day of your life. It's just not physically possible, but your money can. Your money doesn't have a limit to how hard it can work, and your money is scalable, because if you want your money to work harder, you just got to add more fuel, in this case more money, into the fire. You can think of it this way. Let's say you have a $100 bill. Now, you can go to the store and you can buy a nice shirt, and you will come back with a shirt and no money in your hand. Or you can take this $100 bill and you can invest it. Now, your money is going to go away, but after some time, the $100 bill might come back with a friend, another $100 bill. So now you have $200 because this $100 bill got you another friend, another $100 bill, and then you add in another $100 bill into this because you're working hard at your job and you earn some more money. So now you add more money into the mix, and now you have $300 bills that are gonna go out and they're gonna work to attract you more friends. In this case, more money. If you stick with this plan where you take a little bit of cash and you invest it, meaning you're not using it to buy you clothes or cars, you're taking this money and you're putting it into something boring that's gonna make you money, and now it's out working, and then you're working at your job and you take a little bit of extra money from your job every paycheck and you send this to your investment money. Pretty soon, you're not gonna be talking about investing hundreds of dollars or thousands of dollars. You're gonna be talking about investing tens of thousands of dollars or hundreds of thousands of dollars or even millions of dollars, because you're going to have more money going out to attract you more money. Now, this is not the funnest thing to do because you're not going to have the coolest clothes or the coolest cars because your money's out making you money. But this process works. The thing that makes it so difficult, and the reason why the majority of people don't do this, is because you need two things. You need dedication and you need consistency for this to work. Dedication means you gotta say no to the Gucci and you gotta say no to the Beamer for a little while until you can actually afford to buy these things without stressing about the money. No, not the Gucci! The truth of the matter is everybody says they want to be rich with their mouths. That's the easy part. But the majority of people are not willing to do what it takes, because if you actually want to be rich and be wealthy, that means you got to stop spending your money on the things that make you look rich today and spend your money on things that will actually make you rich and make you wealthy. And the tough thing about that is you can't show off your investment portfolio the way you can your new car or your new clothes. Yo guys, you want to check out my dividend portfolio? And the consistency means you have to stick with it, because this kind of money growth is very slow in the beginning. And the majority of people don't really want to wait that long. They want to get rich today. And when people have the mindset of, okay, I'm either going to get rich today or I'm going to get rich never, they end up getting rich never. You can think of this wealth building like rolling a snowball. You start by packing up a tight snowball, and then you put it on the ground and you start rolling it. And in the beginning, your snowball is not really growing because it's so small, so it can't attract that much snow very quickly. But if you stick with it and you keep rolling it, eventually your snowball is going to get bigger and bigger and bigger. And pretty soon, your snowball is going to be huge. And now your snowball will be able to attract snow and get bigger 100 times faster than it could at the beginning, because now you have a bigger pile of snow that can attract you more snow faster. Your money works the same way. In the beginning, everybody starts off with a small pile of cash and you have to start with that. And so it's going to work slowly and attract you money slowly, but eventually it's going to get bigger, and as it gets bigger, it will work harder to attract you more money because you have more money working for you. The next thing you have to ask yourself is, how do you want to get paid? Because when you take this money and you invest it, there's more than one way that it can attract you money. Passive income is a way for you to send your money out today. So you invest your money today, and now you're going to make a little bit of money every month or every few months or every year. One way that you can get this type of passive income is by investing your money in businesses, whether it be on the stock market or not. And now every time this business makes a profit at the end of the year, this business will give you a check of your share of the profit. So now, instead of using your money to go out and buy a brand new wardrobe, you can use your cash to go out and buy, let's say, a 1% share in a clothing store. Now, at the end of the year, if this clothing store made $100,000 of profit and you own 1% of this business, this clothing store will send you a check for $1,000, and you don't have to do any of the work because you're not an employee of the business, you're just an owner of the business, so you're entitled to the profits. A second way that you can get this type of passive income is by investing your money into real estate. And by the way, we talk extensively about real estate investing and stock market investing on our channel, so if you haven't subscribed yet, make sure you do that. Now, let's say you buy a home, not to live in yourself, but for somebody else to live in. Now, the people that are living in your home are going to have to pay you rent every single month for living in your property, whether you are sitting on a beach or whether you're sitting at a desk, because they are living in your property. You bought this asset, this investment, this home, and now they have to pay you rent for using your investment. That means every month you are going to get a $1,000 check from your tenants because you put in the work and you use your cash to buy this asset, this investment, this real estate property that will pay you with passive income. Appreciation is when the value of your investment grows. So if we go back to the business example of you buying a 1% ownership stake in a clothing store. Now, let's say that at the time of you buying this ownership stake, the clothing store was worth $100,000. And now they use the money that you invested and they use their profits to now go out and invest it into their business so they can make more sales and grow bigger. And after a few years, this business isn't worth $100,000, it's worth $500,000. Well, now the value of your investment just grew by 500% because the people that are running the business used your cash to help grow their business, and now your investment grew because of where you invested your money. It's the same with real estate. You might have heard your parents or grandparents talking about how they used to be able to buy homes, beautiful homes, for $20,000. Now that same home is selling for $200,000, $300,000, $400,000, $500,000. And so because of this appreciation, if you buy a property for $100,000 today and the demand for this area goes up, that property could be worth a lot more in the future. Again, in all of these situations, it's not you physically going to a job to get paid. Now you are using your cash, which means you have to spend less than what you make and use this extra cash that you have and invest it and put it into the right places that are going to make you money. But in all these situations, you're not physically going to work to get paid. Your money is out going to work every single day to attract you more money. Now, are you guaranteed to make money when you invest? No, of course not. Investing has risks. You might even lose money, which is why you need to make sure you always do your own due diligence and don't just blindly listen to a random guy on, YouTube. But this is where financial education comes in handy, because financial education is what guides you and can help you make the right investments so you can mitigate your risk. If you can double a penny every single day for a month, you will have over $5 million. Speed is the most important factor to grow your money and build wealth. I can run a mile in 8 minutes. Not that kind of speed. You need to know how fast you can double your money. Look, I have two. If you have just 1 penny today and you can double your penny every day, that means tomorrow you will have 2 pennies. In 3 days, you'll have 4 pennies. In 10 days, you'll have $5.12. In 20 days, you will have $5,242. And in 30 days, you will have over $5 million. Penny? You can do all that? Now, when you're at this stage, every time you double your money, you are making millions. Somebody give me some pennies! In the beginning, doubling your pennies seemed like nothing because you were only making pennies. But as your money grew and compounded, the numbers got bigger and bigger and bigger, and soon you weren't doubling pennies, you were doubling millions. Now, I have some good news and I have some bad news. The bad news is you won't be able to consistently double your money every single day. The good news is even if you only have a penny to your name, you can be a multi-millionaire if you can double that penny 30 times over your lifetime. The better news is if you have $5.12 to your name, you have a head start. You've already doubled your penny 10 times, and so you only need to double your $5.12 20 times in your lifetime to be a multi-millionaire. And if you have $5,242 to invest, you only need to double your money 10 times over your lifetime to be a multi-millionaire. Doesn't seem so unrealistic now, does it? You need to start by understanding what changes the speed of your money. I'm going to start by assuming you have $5,242 to invest. That means right now, if you don't invest another penny, I hope you keep investing more pennies, you need to double your money 10 times to get that $5 million number. But how do you do it? If you put your money into a traditional savings account paying you 0.05% a year, it will take you 138 years to double your money. That means it will take you something like 1,300 years to double your money 10 times so you can get that $5 million figure. By that time, dinosaurs will probably be back roaming the earth. If you put your money into your bank certificate of deposit or CD earning you 2.5% a year, it will take you 28 years to double your money. So you can say goodbye to your millions this lifetime. That means it will take you something like 280 years to turn your $5,000 and some change into $5 million. The good news, if you want to look at the bright side, is your great-great-great-great-great-grandkids will have a few $1 million. If you put your money into a passive investment like the stock market or real estate, where historically these investments have averaged something around 10% a year, now you can double your money every 7 years. And now, we're talking because you can double your money 10 times during your lifetime. Yes, it will take something like 70 years to double your money 10 times and get those multi-millions, but take a look at this. If you invested an additional $10 a day into your investment fund, that's like a Chipotle bowl and some guac, now you can cut that time in half to like 35 years. That's some valuable guac. But now, if you venture out and you decide to start your own business, now you can see returns of 30 to 100% a year. And assuming we just stick on the low end of just getting a 30% return a year, now you can double your money every 2.6 years, which means you will be able to double your money 10 times over the next few decades and you will have your multi-millions. Remember, that's just starting with the $5,000 and not investing another penny. If you invested more money, like you invested your Chipotle bowl and guac every single day, which is like 10 bucks a day, now you can get your millions a whole decade sooner. The thing that you have to understand about the speed of your money is that more speed comes with more risk. Right here in your savings account, you have no risk. You're taking your $100, your $1,000, you're depositing it in your bank and you can get it whenever you want. So you're rewarded with very little returns. If you put your money into a CD, now you have a little bit better returns, but you still have very little risk because the only real risk with your CD is you can't access your money for a certain period of months or a certain period of years. Now, if we go down this with some more speed into these passive investments like the stock market or real estate, you have more speed, but you also have more risk. You're not guaranteed to make money in the stock market or with real estate. Sometimes the markets will go up, sometimes they will go down. You're not guaranteed to make 10%. Sometimes it's going to be higher, sometimes it's going to be lower. So more speed, more risk. And when you come down here to the business where you have the most potential speed, you also have the most risk. The key is you need to make sure that your risk is aligning with your goals, and if you want to speed this process up even faster, you need to add more money into the equation. Plus, there are ways that you can improve your returns while keeping your risk low, which is what I want to talk about in 3 different ways, starting with 1, your savings. Look, your savings are not there to make you wealthy. You can see that very clearly on this chart. But that doesn't mean that your savings have to sit there and do nothing. Second, let's jump to the bottom of this chart and talk about this active investing. This active investing can make you the biggest returns because now not only are you investing your cash, but you are investing your time and your efforts to physically grow your cash. The great thing here is that your upside is limitless. I mean, Nike, Dell, HP, and UPS all started with less than $1,000 and now they're massive. You don't have to build a massive Fortune 500 company to become extremely wealthy, but you get the idea. There's a lot of upside. However, the downside is this comes with the most risk. I mean, you can lose everything, your money and your time. If you want to see the returns that you're looking for through this active investment, you need to have that entrepreneurial mindset, which isn't for everyone. I mean, if you're doing it just for the money, you might as well just kiss your money goodbye right now. Bye, money. If you're not interested in starting a business, then you need to focus in and funnel as much money as possible into these passive investments. Passive investing is when you take some of your money and you funnel it into the stock market or real estate and then you walk away. This is something that everybody, it doesn't matter if you're working a job or starting a business or whatever, this is something that everybody needs to be doing. Every time you get paid, you should funnel a portion of your paycheck into these investments, whether it's stocks or index funds or real estate, it doesn't matter. You just need to keep funneling some of your money into these passive investments. This way now your money's out working hard to build you wealth. The more money and the more time you have, the more wealth you will be able to build. The thing people get confused here is they confuse passive investing as a way to get rich quick. So when they don't see their millions right away, they get disappointed and they stop doing it. The reality is passive investing is not a way for you to get rich quick. It's a way for you to get rich and build wealth slowly. All of this is just a numbers game. You need time and you need money. You can't change how much time you have, but it pays to start early. However, you can change how much money you're putting into these things. So if you want to see bigger returns and you want to see these returns sooner, you need to funnel more money into these things, ideally lower down here. Now, when you start generating this cash flow from the stock market, you can choose if you want to automatically reinvest it to buy you more cash flow, or if you want to start using that money to start living your life. So you have a lot of flexibility with the stock market. So let me start by talking about the difference between dividend stocks and dividend ETFs, and let me go over some examples before we go even deeper. All the examples that I'm